Retired or retiring soon. These overlooked tax deductions could save you thousands, but only if you know to claim them. Many retirees expect their tax burden to shrink once they leave the workforce, but that doesn't always happen. In fact, retirement often brings new types of income and expenses, which can affect how much you owe at tax time. The good news is there are several deductions that can help lower your taxable income if you know where to look. Here are some of the most overlooked tax breaks that could make a real difference in retirement. One of the most powerful deductions involves medical and dental expenses. If you itemize, the IRS allows you to deduct qualified medical expenses that exceed 7.5% of your adjusted gross income. That threshold is often easier to reach in retirement, when income may be lower and healthcare costs are higher. Eligible expenses include doctor visits, dental care, surgeries, prescription medications, and long-term care services. For some retirees, this deduction alone can add up to thousands of dollars. State and local tax deductions may also be more valuable than many retirees realize. Starting in 2025, the SALT deduction cap increases from $10,000 to $40,000 under the One Big Beautiful Bill Act. If you itemize, you can deduct state income taxes, property taxes, or sales taxes, whichever is greater, up to that new limit. This change is especially helpful for retirees in higher tax states or with significant property taxes. Charitable contributions are another commonly missed opportunity. Donations to qualified charities can reduce your taxable income if you itemize. This includes cash gifts, non-cash donations, and appreciated assets like stocks. Using appreciated investments can help you avoid capital gains taxes while still supporting causes you care about. Some retirees also use donor-advised funds to manage larger or ongoing giving more efficiently. Certain tax preparation and investment-related fees may still be deductible. While most tax prep costs are no longer deductible, there is an exception for retirees with rental properties or investment income. Fees paid for preparing returns related to rental income or portfolio management may still qualify. This can be especially useful for retirees with multiple income streams. Medicare premiums can also be deductible in some cases. If you are self-employed in retirement, such as consulting or freelancing, you may be able to deduct Medicare, Part B, Part D, and Medicare Advantage premiums. This deduction can help offset rising healthcare costs while earning part-time income. Long-term care insurance premiums may also qualify for a deduction. Premiums for qualified policies can be deductible up to IRS limits that increase with age. For 2026, deductible amounts range from a few $100s to more than $5,000 per person, depending on age. As premiums rise over time, this deduction often becomes more valuable. Investment interest expense is another deduction many retirees overlook. If you borrow money to invest, such as through a margin loan, the interest may be deductible. You can deduct interest up to the amount of your net investment income, including capital gains and dividends. This can be especially helpful for retirees with larger or more complex portfolios. Downsizing in retirement may also come with a major tax advantage. If you sell your primary residence, you may be able to exclude capital gains from taxes. Individuals can exclude up to $250,000, and married couples can exclude up to $500,000. To qualify, you must have owned and lived in the home for at least 2 of the past 5 years. This is one of the most generous and underused tax breaks available to retirees. The bottom line is that retirement does not mean your tax planning days are over. In fact, understanding these deductions can help you lower your taxable income and keep more of what you worked so hard to save. By reviewing medical expenses, charitable giving, investment income, and other eligible write-offs, you can approach tax season with more confidence. Smart tax planning can free up room in your budget for the things that matter most in retirement.